You know those signs?
Oh,
You know those signs in a factory that are like 10 weeks without an accident, 50 weeks without an accident. I feel like we need that for this show of like 3 weeks started without a scuffed intro and on time. And then this week we're resetting back to zero. I mean, I guess for everyone listening later, it doesn't really matter.
Yeah, exactly. After the fact,
for the booty crew in the chat, we apologize. We're having some technical difficulties there, getting started. A little bit of a glitchy camera, but we're here. It's a holiday weekend, but we wanted to bring a little entertainment before we cruise into this weekend. Jason, I hope you're doing well. Really quickly, maybe a little bit of disclaimer here right off the bat. Nothing we say, do, insinuate, nothing you infer from what we say. None of it is financial advice. None of it's legal advice, accounting advice, tax advice. Honestly, you shouldn't take advice from two strangers on the internet. Shouldn't take advice from friends either most of the time. That's it. I don't know if that counts as a legal disclaimer.
Well, and other than that, a good Friday to you, sir. But I was also laughing and trying to figure out your mic wasn't necessarily popping, but it was already starting to have issues right off the jump. No, and for behind the scenes, I had a new camera set up and everything, and we had to pull the plug on it last minute. It was why we were delayed, and Corey's on daddy duty. And by the way, what do you do? Like, did you?
You sent me a video. I've learned this trick. This is a hack that I've learned. If I put my son in a car seat and just swing the car seat, he just is so calm. So I took him out for a walk in the stroller. He started to get a little fussy, brought him home, and then just swung him in the car seat. And I find if I swing him in the car seat for 5 or 10 seconds, 30 seconds, a minute, he calms down. I can put him down for like 5 or 10 minutes. Then he gets a little fussy. I swing him again. I'm sure some doctor would tell me like it's because I'm cutting off blood flow to his head or something. That's why he's conking out. But I can get like a full hour of peace, just if I get up every 5 minutes and swing him for a little bit.
How tempted are you sometimes to really get that centrifugal force going and pull the full 360?
So what's crazy to me is when we were in the hospital, the doctors were talking about like all these techniques of shushing babies. So like my pediatrician, one of them is he took the baby and flipped him over, put his hand under his chest, his hands under his feet, and just started going like this. I was like, this really feels like you're shaking a child violently, but it's like instantly the kid quiets up. The other one is you take him and you like really rock him in a big motion. And it works pretty well. And I'm like, there's a very fine line of like, I guess if you're supporting their neck, of course, like you're not risking hurting them. But I'm like, if someone swung me around that violently, I'm sure I'd go quiet too, because it would be a pretty concerning feeling. Like, it's not like the gentle bounce of like they're reminded they're still in the womb. This is like you are swinging them pretty all over the place. I started dancing with him around the kitchen, like holding like a dance partner, swinging him around.
I was trying to put so you're on daddy duty. I'm over at my in-laws' house with my niece and nephew today for Good Friday. We're gonna do we're gonna color some Easter eggs later. But I was actually trying to put my niece has like this little like car seat thing, and I was trying to put it on the Roomba so she could go around like a little Yoda around the house. But I want to address some of the things in the comments. By the way, Arjun said that does anyone else have any issue with these showing up in their sub box after the live show? And I'm wondering the help. Good old Tyler's working on that. We're trying to figure out because we do live shows. They don't show up in the inbox quite the same way, I think, on YouTube. So we are trying to figure that out, just so you know. And shout out to David from Trade Busters, who's been on Corey's pod. I did a pod with him the other day. This is his first time in the live chat of Booty Crew because I told him he had to check it out. And I love Moritz said, as a non-native speaker, I feel anxious to identify as Booty Crew as I might be missing some subtext here. You're missing a lot of subtext, but also, it's absolutely ridiculous. You shouldn't want to identify as that, but that's the whole point to the Booty Crew. Corey hates even saying it, but that's why we do it.
Yeah, I don't know how it took root, but it seems to have stuck. And I guess that's what we're going with. I don't know if we'll regret it in 5 or 10 years, but we'll find out.
When we get sooner or later, we'll get canceled either way. But I have one other personal question for you. You send me live videos of you swinging your child around, and you'll be like, "I'm gonna be there in a second." But when you send those videos, your hair is all over the place. What are you doing? Are you slicking it back right before we jump on, or what are you doing?
Oh man, that's a good question. That's probably the best question I've been asked in ages, Jason. What do I do with my hair? No, my hair is. I haven't had a haircut in I don't know 2.5 months. It's pretty bad. If I were to turn around right now, you'd be just like you'd be like, "What is going on with your neck?" It's getting to mullet territory. But the good news about webcams and like only doing
Yeah.
digital
Yeah.
meetings is you're only seeing if I as long as I can get this stuff controlled, we're good. No, I think what happened is I put some product in my hair and then I didn't control it this morning and it was all over the place. So right before jumping on when I saw the webcam, it was a lot of fast handwork, you know?
Well, I think once again, none of this is investment advice or a solicitation for or offering of investment. But for longtime Booty Crew members, they're going to remember that if you haven't had a haircut in 2.5 years, we know how your P&L is doing. I mean, 2.5 months.
Yeah, I'm not sure having a baby correlates.
To your theory?
Knowing how managed futures did last month. Yeah, this might be. I mean, I should show you the grays that came in the last 4 weeks with the market and a baby. We'll talk about the market, Jason. You
Nice
know, I know
transition.
your favorite thing to talk about is macro data, but we did have some macro data come out this morning. The payroll numbers, jobs. It's a weird day because equity markets are closed, bond markets half day. So we do get some bond market repricing. We saw a sudden spike in treasury yields. The narrative I'm hearing is that yes, jobs are slightly softening, but they're still at a cyclical high and they're not softening fast enough for the Fed to justify not continuing to hike. And so the bond market is reacting in a way. I think 10-year yields were up 10 to 15 bips, reacting in a way of pricing in higher for longer. And I know I don't even have to ask you your thoughts about this because I know you're just going to say, who gives a shit? It's one day. It could be noise. Who's trading? All things I agree with. I know you'd even go on to say, who really cares what the Fed's going to do? Does the Fed even matter? Here's my question to you. Maybe the Fed, maybe who knows what the real impact the Fed has. But if everyone believes the Fed is going to have a certain impact, is that enough to create that impact in the market? And therefore, it does matter what the Fed's going to do. If everyone thinks this data is going to cause the Fed to be higher for longer, is that sufficient enough to create a move in rates that can be sustained?
Man, there is so many things you said in there I want to pull out of. Like one is like you can't triple stamp a double stamp. So you're going like you added like 3 things in there. But I thought it was interesting how even with language, like embedded even in the first part of your statement was that the payroll came in softer. So therefore it's not giving the cover to the Fed. That's like a commonly accepted wisdom now, right? And that everybody's been repeating, but we don't even know if that's true, right? Like that's just a guesstimate of how the Fed response function is, right? And so to your point, like there's like we got to have like a some sort of drinking game for like how much we bring up, like we always bring up like Gell-Mann amnesia and stuff like that. Is like is the Keynesian beauty contest, right? Of like
Right.
it's the reaction function of the reaction function of the reaction function, and what does that look like in
It's
aggregate?
reaction functions all the way down, Jason.
Exactly, turtles reacting to turtles all the way down. As you know, and I love that in your whole statement. I love how you had an entire conversation with me in that statement.
Well,
So I
because I
didn't
knew
even
what
have
you
to
were going to
respond.
say. I knew what you were going to say. So I tried to get to a question that at least maybe there's a differentiated response because I know you hate the idea of the Fed reaction function, right? I know you hate the idea potentially that even anyone understands macro, which by the way is a whole segue you and I can go on about Nassim Taleb on odd lots in a minute.
Yeah.
But there's this idea to me that even if the Fed's input to the system is random, like let's say the Fed has a lever they pull and their impact on the system is actually completely random. It doesn't have the impact we think it does. Our understanding of macroeconomics is entirely wrong. Does it ultimately matter if everyone believes that they have an impact in a certain direction with their actions and therefore changes their behavior in a way that causes that impact within markets?
In a way, yes, if we're just talking about markets, right? Because everybody's watching that, and we make this big deal about it. And as we talked about before with zero DTE over the last 3-6 months, that's the only thing that's mattered, right? Is CPI, payrolls, and how the Fed's going to react. Are they going to raise? Are they not going to raise? And everybody's expectations of raising. So it does matter for markets, but like we both know, markets are not the economy either. So it's like, us sitting here circle jerking about the Fed and markets is like most people don't give a shit. And so, how much does that, affect markets too? And that feedback mechanism going all the way down to Main Street, and actual, Main Street businesses feedback all the way up into markets and expectations. So once again, now we're adding in other, more layers than beyond tertiary. But what comes after tertiary? What's for?
Quartiary? I don't know. Quartiary? Oh, wait, but okay, I get what you're saying. But on the other hand, so Main Street, does it really matter? How much does consumer spending change when the Fed hikes rates 25 bips? Perhaps nothing at all, right? But there are investment realities, right? Folks who are having an impact on Main Street, making the decision of where are we reinvesting, when are we reinvesting?
Yes and no, because a couple of things on that. One, as Sean said in the comments, the Jeff Snyder camp of like the Fed doesn't matter at all. I'm not sure I necessarily agree with that. I think just the Fed matters less than people realize. And as I've said before, I think the Fed is just a trend following organization. They're just kind of following the aggregate emergent properties of the markets. But then, the people that make decisions based on these numbers, based on what they guess the Fed are going to doing, is my point is that I don't think it's that large of money movements. They're trying to guess the Fed's movements. So I'm not sure it actually matters. Like the Fed watchers, the most people I see that are Fed watchers are just hedge funds that are crying about their P&Ls, that the Fed are a bunch of idiots. They don't know what they're doing. And then what that means is take a look at their P&Ls. It's usually, if they're in a down year or in a drawdown, because all they're talking about is the Fed.
Let me provide perhaps some evidence to the contrary that I think is kind of potentially kind of interesting.
Please,
because it's a study, and you and I probably feel the same way about studies that can be interesting, but who knows whether it can be replicated. But it's a study that was done back in 2018, where the researchers presented investors with different scenarios, and the scenarios were basically the excess rate of returns on risky assets is always 5%. So the premium for risky assets is always 5%. So if the risk-free rate's 2%, risky assets are going to give you 7. If the risk-free rate is 5%, risky assets are going to give you 10, right? So it's always a constant premium above the risk-free rate. Then what they did is they varied the risk-free rate and asked these investors, how much would you invest in risky assets versus the risk-free rate? You seem to have lost me.
Is it just me? I can't hear you at all.
You're very confused, or you can't hear me at all. Someone in the chat, let me know. Is it your AirPods? Well, now we're going negative weeks now in terms of. Yeah.
Oh, they can hear you, but I can't. So it's entirely my fault. Hold on. Keep talking.
So this study, well, it's important that Jason hears what I say so he can get some feedback. But for those of you in chat, I'll end up repeating this for Jason. The study basically shows that people have a non-linear response in their asset allocation choices based upon the risk-free rate under this condition. So, for example, when the risk-free rate was 0, the median response was that investors would allocate 70% of their money to the risky asset and 30% to the risk-free asset. As the risk-free rate went all the way up to, say, 10, 15%, it actually went down to a 50-50 allocation. They did this in the US, and then they did it in the Netherlands independently, and the two cohorts of people basically had almost the exact same response pattern. It's this non-linear shift from like 80%. When interest rates were negative, it was actually almost close to 80% in equities, and then it curved down and went down to 50% in the risky asset. So we can say that maybe the Fed doesn't have a real impact on the economy, But if they are controlling the risk-free rate, and we believe this study that investors are going to respond to the risk-free rate in terms of their asset allocation decisions, does it not potentially create a behavioral shift among investors?
Yeah, I see what you're saying. I mean, apologize for the technical difficulty. So hopefully I heard most of that. But I get what you're saying now is like it affects portfolio allocations based on what the risk-free rate is. And there's feedback loops that way, how people adjust their portfolios. And yeah, I can see that, but I don't see how watching the Fed and watching payrolls and trying to second guess where the Fed's going is necessarily that helpful. But also, how do you think about, did the study show what happens though when people get there? We really don't have much studies on this, right? When the risk-free rate's 0 and then it goes back up to 4 or 5% and people get their face ripped off on the bond side, how does that impact portfolio construction and shifting into bonds if people have just been burned by bonds?
All right. Well, I think it depends on how much they had in bonds and
Right.
what was going
Like
on.
in your
with
scenario, it's like
equities,
20%, right?
Yeah. So they had like 20%, 30% when rates were 0, and then it went down to became 50%. But right, if equities were going up during that period, then it's a rebalance question. The other thing the study doesn't consider is that if every household and institution in the world cut their equity allocation from 70 to 50, then it would change the risk premium, because you would see equities fall off a cliff as everyone sells them in preference for rates. You would potentially have the problem, again, narratively, that just happened in short-term rates, where all of a sudden it was like, okay, the Fed can't raise anymore. It's creating balance sheet issues for banks. So now what are we going to see? Well, the Fed might even cut, or there's significant pause, as well as everyone who had way too much money in regional banks now has an incentive to move into money market funds, which is going to drive the risk-free rate lower. So it's a little silly about this study is it doesn't consider the second order effects, which are if everyone's running into the risk-free rate, it's going to drive the risk-free rate lower, right? T-bills lower. And if everyone's selling their equities, it's going to drive the risk premium up in equities, in theory, that you could earn, because no one wants them. So it's a little hard to say, because the second money starts to move, in theory, you would be finding some other equilibrium.
So, as you know, and I'm sure you thought about this when you're even starting this conversation, is like, I don't even believe in ERP, in the equity risk premium, right? Or that it should exist, or why it exists, or how long it should exist, and it waxes and wanes. So there's no such, we think over a certain multi-decade period that there's an ERP, but I'm not so certain over a longer arc of history, there's necessarily ERP, or should be.
Okay. I definitely agree it waxes and wanes.
Yeah.
There's an interesting study from Blitz at Robico who shows actually that the risk-free rate historically in developed countries has been negatively correlated to the level of the risk-free rate. Sorry, the equity risk premium has been negatively correlated to the level of the risk-free rate. So when rates are really low, the equity risk premium has been really high. And when rates are really high, the equity risk premium has been really low, coincidentally, which is very confusing to me, because I would expect it to be the exact opposite. I would expect people to pile into equities when rates are really low, driving the equity risk premium down, and just the opposite when rates are really high, which is what this behavioral study suggests. So again, all of this stuff is really hard to tell. You say, okay, it's 16 developed countries. Hopefully this is a robust data set. Well, how many independent periods of measuring of the equity risk premium are there really? And how relevant is the 1880s United States to the 2020s United States? Like, it's just a very different environment. I want to know why you don't think the equity risk premium should exist, though.
Well, before I say that too, like, I haven't looked at the study, and this is what always makes me nervous when anybody brings up a study, is like, until I have time to pick it apart, right? Like, how much of it is like an Ansel Keys kind of study where you cherry picked all the data, right? And what's the replicability? And we, a lot of times they're not,
You know what's funny? I will say I have this bias that if I find an author like Blitz, who I've read a bunch of his papers,
okay,
and I've gone through them, and I'm like, this guy actually, I think, really knows what he's talking about. And then he does another paper, and I'm able to like read the abstract and the summary and the conclusion. I'm more biased to be like, I don't have to dig through this one as deep, because I trust him as a researcher. Who knows? His methodology could have been complete bullshit, but I thought at least anecdotally it was interesting, because it completely contradicts the expected behavior I would think I would see based upon the behavioral study that was done by these other researchers. None of which, though, changes the fact that you just told me you don't believe in the equity risk premium.
It's not just that, it's more of a function of as you know, my general dickishness and contrarianism, and like it goes back to the Fed stuff and everything. And why I don't like talking about this is because everybody goes, this is what our economic textbooks say, and they're fallible. And part of the equity risk premium is like, if something can be negative for decades or a decade long time frame, does it really exist, right? And are looking at too small of a data set to determine if there's equity risk premium.
Hold on,
Everybody just
hold on,
goes,
hold on, hold
go
on,
ahead,
hold on, hold
hold on,
on.
hold on,
I
hold
don't
on,
want to interrupt you because I don't want to bully the
please.
conversation. The equity risk premium is an expectation concept, though. Just because the realization is negative doesn't mean that the expectation shouldn't be positive, right? It's a random distribution, right? So if I say the equity risk premium is 5%, but by the way, the vol around this is plus or minus 10%, then yeah, you can probabilistically have a negative expected return decade. Like that's
so
why
this is
you're earning the equity risk premium.
This is a more fair argument. This is a more interesting argument, actually, because then, like you said, the expectation, right? And as we know, averages don't work in real life. It's that function of ergodicity and time sequencing risk.
Well, they can work in real life. It just means that you need to have a higher expectation because of the compounding effects.
Right. But at the same time,
right, the arithmetic versus the geometric is very different. In theory, we should care about the geometric. We often quote the equity risk premium as arithmetic.
Right. And the hard part is, what I found is, I was thinking about this the other day. When you and I talk to each other, we very rarely disagree about anything, or if it is, it's in nuance. And so it makes it hard to have a conversation because rather you'd like vehemently disagree with me.
But makes the show not only not useful, but potentially verging on not interesting.
Right. But part of it is, like you just said, the nuance of that is like, but you and I know in practice, everybody hears ERP and they go, oh yeah, just naturally I get paid 5% more by investing in equities over treasuries. And that's just categorically untrue.
I don't know if it's categorically untrue. Like here's what I will say. I do think there is a risk that if everyone stops doing asset allocation decisions, if you do have this massive shift to passive and everyone is allocating their retirements to a glide path 401k, you do lose the equilibrium chasing behavior or the equilibrium reinforcing behavior. So I do think there is, at least philosophically, a risk to, like, if this work isn't done and people aren't changing their asset allocation in response to what is being offered and thoughtfully think about what's being offered in equities and bonds, then you miscalibrate the equilibrium. I'm not sure where we are in that state of the world. I'm not sure if passive is too big. I'm not sure how much marginal active money there has to be to drive that. Nor am I necessarily sure we can even accurately estimate the equity risk premium or the bond risk premium or any of these things. They're all very hard problems to solve. But here's what I will say. I think if I were to ask you about certain investments and explain the risks of certain investments and then ask you what rate of return you would demand, right, before, and it's not like, especially if I quoted it as a bond, right, where it's much clearer, I think I would guess there would be, a positive relationship between risk and expected return, right? It's very clear in credit. So why would we not expect it to exist when we jump over to equities?
No, like I think you're making a very good point here. It goes back to, as you know, my my allergy to first principles thinking. When everybody says first principles, I'm like, this person's a moron. And obviously,
I feel like you just insulted me.
Yeah, no, and then I'll come back around. I actually think I see what you're saying, and I think I think you're right with what you're saying. But like, my problem is, as soon as you think I have first principle thinking and I have a founding base layer for economic thinking, this is where you get yourself in trouble. And as you know, I try to shirk off all of those and try to be, a little bit, nimble and limber and be able to move around and not get too codified in my thinking. And to your point, yes, I think that everything should have a layer of risk on top of it, and you have to assess riskiness. But this even is analogous to when we talk about like regional banks and providing local credit to local business owners, right? It's always going to have a higher layer of risk. But the point is, you actually don't know what that level is. You're kind of like guessing in the wind of like what level that should be. And you should have like, a band of what that should be. And that's why I'm saying, like, to have this number for equity risk premium and to think it's within this band of number over the treasuries is a whole, it doesn't make sense to me. And then let's say treasury risk-free rate is kind of ridiculous too, because as we both know, the US dollar is the only currency that hasn't defaulted yet. And so that's not risk-free either. And so this is what I'm saying. If we get it, I get nervous about thinking that these things are based on fundamental truths of reality when they clearly aren't. So even though we're talking about the same thing, but with like slightly different nuances, and we probably just lost the entire audience. So we should probably transition out of this.
No, well, you make a really interesting point. And one of the things I like to sort of talk about sometimes is what is truth when it comes to pricing any of this stuff. Like if someone, I don't think anyone can tell me what a share of Coca-Cola is actually worth. I can tell you what I can sell it for. And I can tell you what I can sell one share for. I can't necessarily tell you what I can sell 50% of the business for, right? That's a different thing.
Right. Exactly.
But I'm almost certain that if there were some sort of, I guess, platonic truth as to what a share of Coca-Cola is actually truthfully worth, I'm almost certain it's not trading there today, right?
No.
To take that to the concept of like the equity risk premium, when I am made in private investment opportunities and someone says, here's sort of where we're growing and here's how much of the company you can buy and here's the current valuation, it's wrong. No matter what I'm investing in, like the price is wrong. It's just hopefully directionally with enough margin of safety that me being wrong is still okay. And then ideally you make up, the extra risk with diversification. So let me segue this though.
No, I want to finish because there was a couple of interesting things you said there. Like you just said, like all the current price tells us is that this is where buyers and sellers met to transact this volume of contracts at this price, and that's it, right? And it is subject to change immediately in the next second, which was perfect the way you said it. The other related thing, and this might help you segue too, is like everybody's talking about like when money was free or they're at zero interest rates, right? But going back where I think you are correct is like that's not true. I don't know where this free money was coming from, this zero interest rates, right? Because entrepreneurs looking for loans to grow their business was in double-digit interest rates, right? Because people were trying to assess risk. And it's different layers and tranches of riskiness. I don't know about you, but I have no access to Cantillon effects. Like I'm not getting that zero free interest rate. I don't see it anywhere. And so to your point, like people are layering on interest rates on top of that, given levels of risk or how close they are, to whatever their level of risk that they're getting their funding rate at. So it's like rates on top of rates on top of rates. When it gets to the end of the people actually taking risk, it's still a double-digit interest rate, even when rates are zero. So then people go, well, rates shouldn't be zero. They should be, in this transition to Taleb, I even heard him saying like rates should be 4 to 6%. It's like, why? Where are you pulling that out of? That makes 0 sense. Like you're just pulling that out of your ass.
I want to get to Taleb. I think to your point about like the free money, I think a lot of people sort of use that as the ZERP shortcut tied to Tina of like, okay, when you're getting a risk-free rate of 0, it forces people up the risk curve. And so money was free in the sense that there was more money sloshing around to do PE and VC and startup and angel, because they weren't earning anything on bonds. And so everything's being pushed up the risk curve. And so for entrepreneurs, there was just more capital out there. And therefore, in theory, if there's more capital out there demanding the same exposure to all these startups, the startups are getting better terms. Whether that actually played out, you only know in a parallel world where rates were 5%, which we'll never know. Who knows? There's people who feel very strongly about this. You and I never feel strongly about macro. And I think Taleb on the Odd Lots podcast put it perfectly, where he talked about sort of the knowledge of a plumber versus the knowledge of a macro economist. And I wanted to get your thoughts on the podcast. This is one that came out yesterday. I've lost all sense of time. It was yesterday, right?
Well, yeah. So I was able to meet up with Ian Castle yesterday morning. We met for breakfast here in Pennsylvania. It was great meeting up with him. It was fascinating talking to him about micro caps and micro cap club and all that stuff. But it was on my drive back from meeting up with him that I was listening to the podcast. And I don't know about you, just clarify for me, is like I was listening to it in the car, but like can Taleb get a mic? Like I could barely understand anything he was saying.
I kept having, every time he talked, I'd turn it up. And then every time Tracy and Joe talked, I had to turn it back down.
Yeah, exactly. I was like I probably blew the speakers in my
I was like, first of all, I don't know who the podcast editor was. They didn't normalize the levels very well. But yes, I was like, if you're going to do a show, get a mic.
Yeah. So part of that. And then so related to what you said, about macro and micro, before we get there, this actually ties in perfectly to what we were just talking about. One of the things that really jumped out to me was Taleb is road biking. He completely 180'd on cardio. because new
know.
studies came out, totally changed his opinion. And this is my whole point. Like, we are constantly in flux. You don't know shit. It's subject to change. Everything we think we're so perfect on now will be the equivalent of like drilling holes in our heads for headaches 100 years from now. And it was just great that he at least admitted he changed his mind on cardio. The problem was, 10 years ago when he was writing about, deadlifting and all that stuff, he's just so convincing, and all of his stuff too. He's like just so
it is
strident.
hard when he is personally willing to do a complete 180 on his position, but he doesn't write it that way. He doesn't say, by the way, my view is subject to change as new information comes out. I'm going to do a Bayesian adaptation to new information. He just goes, no, you need to deadlift. And then he's like, oh, it turns out lifting heavy weights all the time is horrible for your heart. By the way, studies equally show doing cardio all the time is horrible for your heart, particularly if you're a white male. For whatever reason, white males, our hearts have like the muscularity grows when you do all these ultra endurance events more than other cohorts. And so I don't know, man. It's basically, if you don't do exercise, it'll kill you. If you do too much exercise, it'll kill you.
And then before and as you know, like the allegedly too much steady state affects your heart rhythm. And that's why, also people die at the beginning of triathlons because they're not like adequately hydrated because they actually peed out. They're overhydrated. Right. And so it's all those factors involved. But like, before we get to the macro micro again, I just got to address, Jeffrey in the comments said, Taleb said he mumbles and speaks quietly on purpose. And what you were just saying is basically Taleb justifies everything Taleb does for a purpose. That's the problem. And I love how even like Tracy tried to call him out and was like, how are you not a macro bullshitter? And he's like, oh, because I publish papers. And even in the end, they're like, come on, bro. Like, you're human. Humans be humans.
Humans be humans. Yes, he does justify all of his actions with foresight and hindsight. And it is pretty funny. I love him. Listen, I got to say, I enjoy him. Controversial a personality as he is, and as perfectly timed as the Black Swan was right before 2008, that sort of catapulted him to fame. Fooled by Randomness is still, I think, one of the best books I've ever written, and a book that I would highly recommend for any 16 to 18-year-old.
No, you're right. To me, it's in that compendium of, I don't like to actually recommend like a set frame of books. I like to individualize it to people, but you're right. Like if you had to, it's definitely in there. But also, as listening to the podcast, who knows if Corey, you interpreted it correctly? You probably misinterpreted it according to Taleb.
I definitely didn't.
And so to your point though about macro micro, right? Like a plumber understands plumbing, right? Because the micro. And then they're like, this is why global macro, we hate it so much because everybody's full of shit, right? Like that's the problem. Is like when you're talking about complex systems, integrating complex systems, you have no idea what you're talking about. So we can bring it back to like, there's a few ways to think about that. But also what Taleb is reiterating is the Hayekian problem, right? Like Friedrich Hayek already talked about all this stuff. And honestly, the great books, it's two things about great books that are interesting to me. One, people are just kind of like syncretizing information for you, right? They're editing down information that's already been there in the past for you. And so you get to maybe see it in a new light. And quite frankly, that goes back to like Nietzsche and even, Montaigne were philologists, right? They were interpreting Greek and Latin texts. So therefore they were, pawning off the ideas from, the Greek and Latin philosophers. And everybody thought it was ideas, but like it's turtles all the way down as that's part of our drinking game. But part of that, so he's repeating Hayek in that sense. But then what I want to remind us about is, and hat tip to Jason Josephiak. He sent me one of the old Benchmark Plus like newsletters, and it was just talking about a lot of this stuff. And like it was talking about Philip Tetlock, right, in forecasting. And I'll just read this real quick. It was, in 2005, Tetlock published a book called Expert Political Judgment. He examined the predictions of about 284 prominent journalists, academics, advisors, and national leaders to determine whether their political, economic, and social forecasts came true. The famous conclusion of the book was that the average expert was roughly as accurate as a dart-throwing chimpanzee. While they weren't good predictors, they were good storytellers. As John Kenneth Galbraith said, the only function of economic forecasting is to make astrology look respectable.
Well, I love the point that Taleb was making. By the way, I can never say his name correctly, Taleb. I can't say it correctly because I had a friend who had the same last name who went by Taleb. So
I don't know I'm not Lebanese.
I'll defer to however he wants to be referred to. I apologize.
Greek Orthodox, I guess.
Wrong. Nassim. The point loved that he was making with macro versus plumbers, which I think is one of the I think was well articulated to why you and I have a particular disdain for macro. Is the plumber has experience that is repeated so many times in their micro domain that they can be an expert, right? They can see almost every problem they will come across and develop an understanding and an expertise for it. That is not the case for a macro economist who can't interact with the system, who can only observe the system, and the system is so complex and changes so slowly that their understanding of the system may be completely wrong, and there's no way to get the feedback, right? The plumber, when they do something wrong, the pipes burst. They get the feedback and it forces them to adapt and change their understanding. The macroeconomist, how many macroeconomists do you know that have had the same view for 20 years and been on the wrong side of the market? Right? But they're adamant that they understand how the world works. It's that the world is wrong, not them.
Yeah, of course. And then their prognostications versus trading never matches up too. By the way, I got totally distracted because I swear in the comments, Tyler is making jokes and then laughing at himself on the jokes. He's responding to like he wrote, I was told it's pronounced Taleb, he just wrote it out. And then the next comment is him laughing at his own joke. Sorry, I got distracted there. But like to your
This
point,
is why
like,
I don't turn the comments on.
Right. No, as one shouldn't. But like related to what you said, I've always been fascinated by surgeons, and honestly, Taleb might have even talked about this too. It's like because my sister and brother-in-law are both surgeons, right? And to your point about iterative feedback, they're the only really form of the medical profession that gets iterative feedback, right? A lot of other forms of medical profession, they learn everything in school, then they go out into the world, and they're not getting a lot of iterative feedback, nor are nor do they have the time to keep up with the latest science or the medical research. So they actually get worse as they get older, where surgeons tend to get better as they get older through experience.
That's an interesting thought, something I hadn't considered, but I see that could absolutely be true, right? If a doctor is recommending certain medication, it's not like they're necessarily doing large trials for that medication, right? They're seeing a case, they're pattern matching, they're identifying what they think is wrong, they provide the medication, whether it works or not, right, is a sample size of one, like versus a surgeon who does the same surgery hundreds and hundreds and thousands of times a year, right? To your point, gets that experience and starts to see every scenario and gets rapid information and experience under very dire potential consequences, right?
Yeah,
So it's really important that they update their understanding.
I don't speak German, but it's like Fingerspittel or something like that. It's like finger feel. And they would talk about the German tank commanders in World War II. They had this amazing finger feel. And that's why they were some of the best tank commanders in the world. And it's just through iterative feedback in multiple iterations. It's like Boyd's OODA loops, right? You need that feedback to get iteratively faster. And the more you can increase, or the faster you increase, or the more iterations you can get with your OODA loops, the better you can get over time.
This is something that's been coming up in a lot of my conversations with quant managers lately. Is a ton of people I know who used to do what I would call slow frequency alphas have started to move to mid frequency. And so they've gone from alphas and signals that they thought sort of matured over 6 to 12 months to alphas and signals that might be a week to a month, to even some are trading 5 days, forecasting 5 days. And the conversation has been really interesting. Part of it is they get much more rapid feedback, but at the slow horizon, you typically get lower sharp strategies.
Yep.
They tend to be like more of a 0.3. And the reality is, to survive a 0.3 strategy over the long run, you're going to suffer a decade drawdown in that strategy. And it's impossible from a data perspective to tell whether that strategy is broken or it's just going through the usual randomness. And so there's a huge faith-based element in the alpha. And that's really hard. And so you end up with these diversified systems of multiple alphas that you're combining together, but you have very little belief in any individual alpha. Like you wouldn't run it high levered on its own. And so a huge number of people that I know that started in the early 2010s doing a ton of the slower style premia have recently moved to much faster systems, particularly in futures markets where the trading costs are much lower.
Yeah, but you still have, oh God, where I make sure I don't get myself in trouble here, because this is top of mind for me. And as you know, this is one of my favorite topics of alpha, and whether you can prove it or not. And I annoy the shit out of everybody with this, understandably. But we were discussing the other day about, people that were, prop traders or floor traders now trying to run funds, and then the transaction cost of running funds, erodes away all of that supposed alpha. Like if you can run on shorter timeframes, right? And then to your point, like the medium to longer time frame, you want more iterations to prove what you can possibly do. But at the same time, as I always joke with our value friends, and I was just talking about Ian about this the other day, is like, if you're a value investor and over the entire lifespan, your personal lifespan, if you only get 100, 200, 300 stocks, like there's no way to know that if you're good or lucky, right? Like you need at least probably 500 to 1,000 iterations to start having any statistical significance. And so to your point, it's like, if you can go shorter time frames, you can get much more at bats. We can start having at least some statistical significance. And what's great about this, and where this leads us right back to Taleb, is we could throw all this shit right back on Taleb. Like, for example, like what Universa espouses as far as like tail risk hedging, right? If these events happen once every 7, 10, 13 years, pick your poison. How often do they happen? And over the time horizon of a trader managing this, let's say there's only been 3 events where we had a liquidity cascade where they could have made some money. How do we know whether they're good or if they're lucky? We don't have any iterations there. So we have no clue.
Well, so let me put it another way. Is there a way to benchmark it to a naive strategy, right? And say, okay, there's only 3 examples, but during the periods where you expect them to lose money, they bled far less. Right. And
you front ran me. Yeah.
Can you increase the frequency by almost inverting the question and saying, well, let's look at the full sample of what the yes, N equals 3 for the big pops. And man, you hope they hit those pops, right? But what is the naive strategy that could have been implemented as the counterfactual, and how did they do relative to that?
Man, you nailed that. You just front ran it, because that's the way to think about it. Is the inverse, is where they're proving their alpha is on the cost, the premium bleed, that protection. And if you're doing it on a monthly and quarterly basis over 20 years, you can get a lot more iterations, and you can start to think and then benchmarking. But that's the hard part, as you know, in vol and tail risk, like what's your benchmark? But that's where you can prove that you're good versus lucky. But then more importantly, you still have the inverse problem again, is if these events happen once every decade or whatever, it's like, the ability to monetize these before vol mean reverts is incredibly delicate and precise. And so you still never know that. And that's when you need them most. You need that pop to cover your equity beta. And if they don't monetize it correctly, you're not covering that equity beta. And then more importantly, if they do monetize it perfectly and there's a second leg down, you have no protection for that second leg down. So to your point, yes, you can, where you can show your worth is in the cost of that protection. Well, what we will never know is if you will monetize it perfectly when it does actually happen. And so you're leading right back into the second part of the Taleb thing that happened this week, is like, how and why in the last few weeks did Boaz Weinstein and Cliff Asness all of a sudden reignite the debate about Universa's numbers in 2020?
I don't know. I want to go back to something you said really quickly before we go into the debate, because I want your thoughts on this. So one of the mental models I have with tail hedging is that convexity and path dependency go hand in hand. So what do I mean by that? If you hedge one very specific outcome that only occurs 0.00001% of the time, you can probably get a huge amount of convexity. The more specific the outcome you're trying to hedge, right? If you say, like these multi-leg trades, I want gold up, stocks down, bonds down, you can get massive convexity because you're limiting the path over which that hedge hits. So one of the things I often think about when you see these absolutely absurd tail hedge returns is, how close were they to being on the wrong path, right? I sort of think of like all these paths in the woods. They're saying we're only hedging this one over here. Well, what if the market had taken like the one path to the left of that and it was still a really shitty outcome, right? Should we be clapping for the firm that provides the most convex return, or should we recognize, like, is that skill or did they just get lucky? in that the market hit the one path perfectly that they hedged, right? You're a guy wwho runs, oh God, can we even talk about this? Who
Yeah, I can talk
happens to
about
have
mine.
experience in diversified, tail hedging, right? And so almost by definition, you're hedging a whole bunch of paths, which means whatever the outcome is, I can almost guarantee you will not have as good a return as someone who just got lucky and hedged that one path. Now, did they have some perfect crystal ball foresight to hedge that path and know this is the hedge to put on, or did they just get lucky?
No, to your point, and this goes back to the Tetlock thing about we love narratives and storytelling, right? And as a society and in the news media, we love to tell the story of the lottery winner. So in hindsight, right, we're going to publish the one that got that path perfectly, and we're going to forget about all the ones that didn't. And you and I talked about this even with the Big Short people. Like if that had gone on for another 6 to 12 months, they would have blown up. But we love telling those stories, right? That the people got lucky on their timing. And you and I always say we'll rather be lucky than good. But to your point is like, yeah, if you want like dual digitals, like gold up, dollar up, right? Those sort of parlay bets, yeah, you can get unbelievable convexity, but you got to stick the landing perfectly, to your point. And so, yeah, it's what do you want, right? Do you want to, if we cannot a priori know what that path dependency is going to be, you better have a lot of things to cover it. You front ran me too, because I was going to say, I think Corey, this might speak to ensembles and also rebalancing timing luck.
Yeah, probably.
But that's the other thing I didn't bring up. The second part I didn't mention about books, especially like Taleb's books and everything. This is what fascinates me, is you and I both love Fooled by Randomness, right? But why do we love it? Because it agrees with basically all of our thinking. So it's just solid. And we're like, 100%. Taleb's a genius. Like, look at this book. This is brilliant.
I only recommend books that agree with me.
Exactly.
All right, but I want to actually. I know we don't talk markets a lot. We definitely don't want to do that on this show. But one of the interesting things, it was end of quarter last week, which means I spent a ton of time doing end of quarter performance analysis and decomposition. And one of the things that sort of caught me off guard over the quarter, particularly at the end of the quarter, was the divergence between bond volatility and equity volatility. Like, I don't know if you saw this in your vol managers, but I saw this in my vol positions, especially long dated vol positions. Long dated vol just like fell off a cliff over the quarter. And I'm curious as to, I'm sure you don't have a take. Maybe you can spit a hot take for me, just for the sake of entertainment, for clips on TikTok and Twitter, Jason, and YouTube. Make us go viral here. But I thought it was pretty interesting that you had this divergence between bond vol and equity vol. I don't normally feel like you see asset class vol diverge that violently. And then just the fact that these long dated vols fell so much in equities in a way, especially where the market narrative I continue to hear is the recession is coming, the recession is coming.
Man, there's so many things in there I could go with. One, though, I think the story since 2020 has been a divergence between equity and bond vol in both directions, right? And then it's kind of what we talked about, I think, on the last episode. To me, like, money just flows to these different asset classes around the world. And people try to actually say, well, historically, it went from this asset class to this asset class to this asset class. And that's how they it goes from like equities to bonds, FX, or, so I don't really buy into that, as you would assume. But yeah, it moves from one to the next. What the actual, what the next one will be, we never really actually know. But that's why you see those divergences there, right? The money, is you see the fragility move from one asset class to the next. But at the same time, what I think you're seeing more in equity side, talking in hindsight, obviously, and this is an understandable thing that happens in markets all the time, is in 2022, SKU got flattened, got crushed, deep out of the money, tail risk protection and equity vol got crushed. Like you're saying, longer dated equity vol got crushed. A lot of people that are playing, Vega or implied volatility on longer dated stuff, they got crushed. And then so people are moving more because gamma and restriking, close to the money, nearer term, really worked in 2022. So people are always fighting the last battle. That's all I see. That's my I don't have a hot take for you. I'm just talking about hindsight bias, narrative fallacy. But like basically what you see is like
strategy chasing, basically, is what you're
saying.
Strategy
chasing.
Vega didn't work, so people are getting out of the Vega positions and they're going to the gamma positions.
Right, exactly. And then when eventually that's going to get, Vega will come back and gamma will get burned and we'll do the same thing all over again.
What are we going to do tonight, Pinky? Same thing we do every night. All right. Let's go back to Boaz, Cliff, and Taleb and Universa. Because I agree. I don't understand why this came up again. I think it was Justina Lee at Bloomberg wrote the article that sort of, not that she set off this firestorm, because I think it was Boaz Weinstein who was tweeting aggressively about it for, I don't know why, just saying like the way that Universa reports returns. I don't want to say he was saying it's criminal, but it sort of seems like it violates every reasonable standard of how returns are reported, as well as, I didn't realize this, the amount that they claim on their ADV that they manage is like like the notional exposure of coverage, which to me is absolutely wild and not in line with the definition of AUM or AUA in any reading. But on the other hand, Universa is such a well-known fund. I have to assume the SEC has been in there, right? Like maybe not.
So this is the problem. Now you're going to learn a little bit about my world. Depending on the size, makeup, and quality of your actual LPs, let's call them, just to make it simple, is your reporting requirements change. And because they're basically unregistered and exempt, they can say whatever the hell they want to say. And that's what people don't realize. Versus what I have to say, working with accredited investors is vastly different from what they say. And in my world, people will change from accredited to QP to QEP to large institutions or offshore exempt institutions. So that way they can report very different things. The reporting requirements are a lot less depending on who your LPs are. And that's what's happening.
I understand that, but I have to go reread the article. This was an SEC filing.
Yeah.
Now, whether it might have been what is it, like I think it was part of their ADV, in which case it doesn't matter who their clients are. Like there's a definition the SEC uses for those measures. Again, I haven't firsthand checked this. This is what I read in the article. My understanding might be wrong. Regardless, not the major point. The major point being, again, should they be quoting a 3,500% return? Like, should you be quoting return on premium for a given month?
No. And I mean, did you see the Aaron Brown article where Aaron Brown is like, somewhere in between? That's what's interesting. Aaron Brown is like, he's just being ripped in half, right? Because Aaron Brown is homies with Cliff, but he's also homies with Nassim. So it's like he was trying to straddle, and it's like this just did not work.
I know.
I mean, if you can parse it out, like this is, as you know, I do not want to talk about this anymore because it was the bane of my existence for 2020. This 4,000, 3,600% return. It's basically what every tail risk fund did. And like, if you're quoting off, monthly premium spent, oh, great. For the last 12 years, every month you lost 100% in your funds. So it's like, I don't necessarily want to get back to that again, except for, like you said, a lot of times Universal will quote their AUM as 16 billion, but that's the equity beta they're protecting against. And if they're just taking 2% for the premiums, they're actually only running 320 million. So you and I would report our AUM as 320 million. They like to say 16 billion. By the way, I don't know what comment thread it was in, and forgive me, I do not remember the commenter, but it was the best one I've ever read. They said, actually, my dick is 3 feet long because that's the length of the pants that cover it.
That's really good.
That was really like the most perfect response to like the universal quote of 16 billion like I've ever seen.
That's really good. Yeah, I mean, it's tough because I actually, not so much on the 1 month return, which again, it's like, okay, if you want to say that particular trade earned you 4,600, 3,500, whatever the number is, like, I get it. That's the premium. It was a massively convex trade. What gets more frustrating is when he talks about how the return at Universa, I think he said, was like having an annuity that paid
114%. That one kills me.
And it's,
you have to explain that one.
Yeah, I got to go back and redo it. The broader point he's trying to make, and I think this is just where it's marketing language, trying to massage the conversation to get people to understand, is that these sorts of strategies lose a lot of money most of the time, right? You're going to burn your premium, and then you're going to get hopefully these massive payouts. And it's the combined rebalance contribution, right? Harvesting that premium, plowing it back into risk assets, and rebalancing that creates, hopefully, a positive return, a positive contribution to the geometric returns of your portfolio. the individual arithmetic returns might be negative, right?
Right.
And so the question becomes, okay, if your return was like, the weird math is if your return is 9% on the S&P annualized, your return on the strategy is say negative 1% annualized, but you combine them and somehow end up with an 11% return. Well, who gets credit for that? Right? If I happen to get a huge payout exactly at the market bottom, pay that to you so you can reinvest in the market when it's cheap and then the market rallies, who gets credit for
The
that?
allocator should.
Right? Like, and these are the interaction effects
Right.
that when you talk about a portfolio, these interaction effects are actually incredibly complicated to do attribution on, but they can have a meaningful impact, particularly when you're talking about massively convex payouts. And so I think what he's trying to do is say, well, I get credit for that. That's me. I did that for you. And he's not, and in some senses, he's not wrong. But in other senses, it's completely wrong.
Right. Well, that's the hard part, is like there's so many things in there. And what really matters, the real rub to it, is what's your bookends, right? And that's the hard part, is like they go back to 2006, so they make sure they get 2008 in there. They make sure they get 2020 in there. It's like the longer it goes on in between, like as we were getting into 2019, they were running, below the S&P, right? Like, and Boaz is also saying, like, you're picking and choosing the S&P and not necessarily bonds or a 60-40 portfolio. Like, all those things are argument, right? And so we can never know for certain, over what time frame will it work. And that's why it's kind of cherry picking the data to say over this bookended time frame, you had this annuity. I think that, and then to your point, like the annuity thing was just like out of the left field. I'm like, why would you ever say that? And I'd really wonder, even though,
especially because like the guarantees associated with annuities was like, oh, this isn't good language.
But do you think, I really wonder, and I should ask one of our friends that works there, is like, do they just sit around and go, oh, this is somewhat true, but this will definitely get headlines for us? And then they're like,
I think he's a marketing genius.
Right.
I mean, I think that's why he does the books. I think he loves all these articles, right? Think about all the free marketing that they're getting right now.
No, it's insane. I know. I'm like, why are you talking about it? You're just
we just spent like 20 minutes talking about this. Not that our show is marketing for Universa, but you know what I'm saying? Like, they're getting the discussion, and there's a huge part of asset management. Yeah. You get Bloomberg talking about it. Oh, that gets, Taleb on odd lots, and it gets, when Cliff is getting mad about it, great. Now Cliff's drawing attention to it. And the reality is, for most people, they don't remember what the article was about. They remember who the article was about in 5 years.
Right.
And so that name Universa just sticks in their head.
And this is our whole thing of storytelling, like history, right? Like the history is told by the winners. And so whether it's Cliff Asmus, Boaz Weinstein, or Nassim Taleb and Mark Spitznagel, they're all gaining from this. They're all gaining AUM from this, because nobody's, like you said, nobody's hearing, like, actually digging into the returns. Nobody really does due diligence. They just know they're celebrities, and these are big names, and they pick fights on Twitter. But speaking of rebalancing timing luck, we are going to really test our abilities on this show of our technical abilities, because I had some charts that I sent to Tyler so that we could maybe pull up. But I don't know if you had a chance to look at this article, because what I always hate is when all of these robo-advisors go, oh my God, if you missed out on the 10 best days of the S&P 500, your return would be terrible. So it's all about time in the market. Just invest in these robo-advisors or index. But nobody ever really shows, what if you missed out on the worst days? And that's what we always try to show.
This is one of the charts I made in the early 2010s, because trend following, right, especially in equities, the best days and the worst days tend to coincide because they're high vol days, and volatility regimes tend to cluster, and vol and market returns have a negative correlation for forward market returns and current vol in equities historically. And so trend following, they always say, well, you're going to miss the best days. Well, trend following also misses the worst days most of the time. Right. And so you end up with this unbelievable effect, I'm using air quotes for those listening, missing the best, missing the worst, and ending up in theory almost in the same place with a smoother ride.
Right. Tyler, can you show the other chart first? So what I thought was interesting, this is a PGIM article on napa-net.org. Tyler put it in the notes. But the other chart was interesting because everybody shows missing out on the best days. But as this chart shows, if you can miss out on the worst days, you end up, with a higher CAGR. And that's most important.
Yes.
And obviously, you and I believe in that because you're truncating the left tail, you're reducing your volatility tax, which you and I hammer on about it forever. By the way, if those on the live chat, if you're looking at this, the orange, that full period is from like 1936 to 2022. And then the blue is the last decade, 2012 to 2022, because
And
it just shows it
often,
more than the
yeah.
whole time frame.
And so for those who are listening, like the what happens here, right, is if you miss the 20 best days, your return obviously goes way down. If you miss the 20 worst days, your return goes way up. You don't, you have the none, which is in the middle. What's interesting a little bit is actually, and I wouldn't have guessed this, missing the 20 worst days gets you an extra, if I'm doing my math in my head correctly, 11.9 percentage points versus missing the best days loses you 14.6 percentage points. I would have guessed it's actually, you would have, it would have been asymmetric because the worst days are usually worse than the best days, but there must be some compounding effects here that come into play. So,
yeah. But what I thought was,
no, sorry, this makes complete sense.
Yeah,
yes,
what do you're going the other way. Yeah,
I know. I'm doing it backwards because you keep all the worst days. Yes. So the point here being the asymmetry, if you were able to avoid the worst, that's even better because they tend to be bigger than the best. I just confused everyone. I apologize.
and Tyler, if you could pull up the next one. And so Corey, my apologies that I forget that, or I missed your article where you wrote on this using CTAs, but you usually see, a lot of times you see the best days, and I can't help it, but even on, I think on Tim Ferriss's podcast, when he's doing an advertisement for one of the robo advisors, all they talk about is missing out on those 10 best days, right? But nobody shows the worst days. So we're just trying to show because you want to reduce that volatility tax. But what I almost never see is somebody combining, what if you missed the best and the worst days? And I thought that was a more interesting chart in the article because I've never really seen that before. But are you saying you've done that before, to taking out both?
Oh yeah, this is like verbatim. I can send it to you later. I'm sure I have advertising materials from 2010 that I created that is almost identical to this.
And Menahem's asking, how much is this because you need a higher percentage upside to make up for the equivalent percentage downside day? And that's exactly what we're talking about, right? That's that volatility tax due to compounding, and things we're always talking about, ergodicity, et cetera, and compounding versus arithmetic returns. These are our favorite
and
things.
That the left tail tends to be bigger than the right tail. So if you look at the worst daily loss versus the best daily gain, the worst daily loss tends to be bigger than the best daily gain. So not only do you have the geometric compounding effects that come into play here, but you have the fact that when you cut off the left tail, if you're doing it by number of days, that average loss tends to be bigger than the average gain that you're giving up with the 10 best days.
Yeah, because things like stocks are implicitly short volatility, so they're left tail or left skew to the downside.
Yeah. Yeah, this is important stuff, right? And I think it's always like, this is a good example. I think a good thing to end on in terms of thinking the way all of this stuff is advertised, right? The last 20 minutes of this conversation has all been about how asset managers advertise in many ways and how they choose and pick data that supports the narrative they're trying to tell. And for strategic buy and hold, it's always that time in the market is better than timing the market. And so they find this stuff that says, well, what if you're in timing the market, you happen to miss the best days? Well, if you're randomly picking your time in the market, if you have no signal, you're just as likely to miss the worst days as you are the best days.
I think it's a perfect place to end this one.
Awesome. Happy Friday. Happy weekend, everyone.
Happy Passover, happy Easter, happy Good Friday, happy weekend, happy everything. By the way, did you see there's a rule that the markets can't be closed more than 4 days in a row? I mean, obviously it got broken in 9/11, but like, this is why you can't have a 3-day weekend. This is why we have that one day at Thanksgiving where the juniors have to come in, work and everything. It's what a stupid rule.
I didn't know that.
So the gap risk obviously over a 3-day weekend is a lot harder, especially for those of you trading options and selling options. You know exactly what happens over a 3-day weekend. So good luck to all of you.
Well, isn't that the whole edge with the VIX? They keep pumping the VIX lower on a Friday.
Yeah.
That's why.
Exactly.
Okay, awesome. Well, thank you everyone for tuning in. No, we didn't talk about last thing. If you made it this far,
oh shit,
please support the Pirate Pinky Promise. Jason, you want to tell them about the Pirate Pinky Promise?
Sure. We don't do this show for free. This is a pirate's agreement between all of us. Some would say a gentleman's or a gentlewoman's agreement or a swashbuckler's agreement. The idea is it's a Pirate Pinky Promise between you and us. We produce this content, so hopefully you enjoy it. But we appreciate if you'd like, subscribe, tell a friend, hit that notification bell so that way you hit get to see these live shows, be part of the Booty Crew. The comments are always on fire as always. Corey's smart not to look at them because I get highly distracted. You can always see me laughing as I read comments and not listen to Corey because I enjoy the comments more than I listen to Corey because I listen to Corey way too much. Otherwise, Pirate Pinky Promise. Please uphold the Pirate Pinky Promise. Share it on Twitter. Hit that like, hit that subscribe, hit that notification bell. Nothing we say is investment advice. We're two idiot pirates talking nonsense on a YouTube on a Good Friday. Why would you listen to us at all? Seek out your own professional investment advisor. With that, we're out.